Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Let's get to one of the key data points really before next week's Fed meeting. I feel like, Tim, we just keep counting down, jobs report, inflation reports, just different things we kept kind of making our way through.
T-minus 7 days.
Well done.
We get that Fed decision.
I'm kind of excited. What we got this morning, though, was another read on inflation. Data that showed underlying U.S. inflation unexpectedly picked up in the month of August. Higher prices for housing and travel. So maybe that 50 basis point rate cut that some have been banking on, not going to happen.
Let's ask Bloomberg News International Economics and Policy Correspondent Michael McKee. He's here in the studio. So headline numbers, Mike, what everyone is talking about, the so-called CPI. Does it rule out 50 basis points come next week?
No, it doesn't rule it out, but I think the Fed's default position was always 25 basis points, and the 50 was sort of a wish on Wall Street that they are now ruling out for themselves. If you look at the overall numbers, we saw the headline CPI come down to 2.5%, and we saw the core at 3.2%. But those include 12 months ago. Well, that's an annual rate, but that's irrelevant now. If you look at it on a 6-month basis, the headline is at 1.9%, and the core is at 1.8%. If you look at it at a 3-month basis, the three most recent months, you're at 1.15% for the headline and 2.4% for the core. So you'd be, especially on the headline, thinking, well, maybe we're too low. You
would the Fed think it's too low? Do they look at that 3 month?
I don't think they would look at it that way, but okay. They are. If they wanted to do 50, there would be an excuse in that. They could say that the economy may be slowing too fast.
Do they need to do 50, Mike, in your view, when you look at the rest of the statistics?
And I think that's why the consensus has emerged around the idea of 25 is because the economy is not falling apart. We're still seeing strong consumer spending, and we're seeing jobs reasonable. We didn't get quite as many last week, but we saw the unemployment rate fall. Mm-hmm. So there's not a flashing red light out there that says we got to move quickly.
There is a flashing red headline that I do want to bring to your attention. It's kind of perfect that we have you in here. The Fed's Inspector General releases a report on Bostic's investments. The Fed Inspector General didn't find evidence that Bostic traded on confidential information, Mike. Remind everyone what was going on here.
Well, it's kind of an offshoot of the earlier Fed issues about whether they properly disclosed that it was the Boston Fed and the Dallas Fed. And, even Jay Powell got caught up in it.
I had forgotten that Boston got caught up in it.
Did they disclose accurately what trades had been done? And so the Fed, after the initial round, tightened the rules. And the way the story went, there was Bostic had to refile his financial forms because it turned out that he had that there had been trades made during a time period when there shouldn't have been trades made, which brought up the question of whether there was a confidential conflict of interest. And what Bostic said at the time was that this was a mistake by his trustee who's keeping track of his money, because they didn't realize that the rules had changed. And I guess the Inspector General says, yes, the trades created the appearance of a conflict of interest, but it wasn't him doing something based on confidential information.
So just remind us going forward, and then we'll go back to the inflation data. So things, though, have changed in terms of oversight of Fed officials in terms of trading? Is it what
Yes.
came out of all of this?
Well, they completely changed the disclosure rules, and they have to disclose any trades. They can't make trades at certain times now, and there are some things they're not allowed to trade. So it's a much tighter regime, and we get the financial disclosure forms every year, and they haven't suggested anything bad in a while.
All right. Good to know, because you're right. It's been a while since we've got a headline.
Boy, reporters just pour over those now.
as we do, and as we also pour over, these economic data points, especially because we've got a Fed meeting next week, and we know this is going to be probably a big one, right, where the Fed actually starts to cut rates. Having said that, the economic risks right now, Mike, in the U.S. economy, is it more on the labor market side of things? Like, where are the risks? Because I do feel like with this political election, the economy is still front and center. I was away and I was talking to somebody and I was making a purchase and it was under $100. And I said, oh my God, it's so nice to make a purchase that's under $100 because it doesn't feel like you get away with groceries
was
or
it bacon?
What have you.
Was it food at home?
It wasn't.
Things we're going to talk to Mike about in 30 seconds.
It was not bacon or food. But what she said to me is, I get my paycheck, I deposit it, and it's gone right away. And it just speaks to how many Americans are struggling right now.
I think you probably would have heard that prior to the pandemic, too, what people tend to forget. The idea that, yes, the price level's gone up for a lot of things. Input prices went up, and so that fed through. And now they've basically sort of stopped rising, but the level of prices is higher than it was. The one thing everybody leaves out when they come out with those statistics, though, is the level of incomes has also risen, and in the last year been higher than the inflation rate. So you're really still ahead of inflation. But what sticks in your head is when you go to the grocery store and the price is higher. Right. You're not thinking about, well, I made a little bit more in my paycheck this month because that was me. I'm so great, I get more money, but I'm getting screwed because the prices have gone up.
But as you reminded us on Bloomberg TV this morning, some prices are actually coming down, including grocery prices. This came up last night at the debate.
Yeah, they asked me about the financial aspects of the debate last night, and I pointed out that grocery prices were a big deal. They were down, they were flat this month. They were down by a tenth last month, and basically they've been flat for a couple of months. And I think Trump brought up bacon. Bacon prices have been down big for 2 months now, down 1.7% this past month. And then I noted that if you had to replace a pet prices were lower.
You had to go there, huh?
Had to go there.
And if you don't understand that, just Google.
Just watch the debate.
Just watch the debate, which you all should as good Americans. Mike, thank you so much. As always, Bloomberg News International Economics and Policy Correspondent.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We continue with our coverage of last night's debate. As you know, Democratic Vice President Kamala Harris and Republican former President Donald Trump, sparring through their first debate, with the former president often on the defensive over abortion rights, the January 6th insurrection, on foreign policy, and sometimes on trade.
Well, let's be clear that the Trump administration resulted in a trade deficit, one of the highest we've ever seen in the history of America. He invited trade wars. You want to talk about his deal with China? What he ended up doing is, under Donald Trump's presidency, he ended up selling American chips to China to help them improve and modernize their military.
And that, of course, was Vice President Kamala Harris talking trade with former President Donald Trump, her views on the Trump trade policy. Let's get more on the debate and the political conversation that is and that maybe needs to be. Back with us is Stefan Selig. He has worked in leadership roles in both the private and public sectors, including a nearly 30-year on Wall Street, former Undersecretary of Commerce for International Trade at the U.S. Department of Commerce during the Obama administration. He also headed the International Trade Administration. His background is so rich, which is why we lean on him a lot. He is also managing partner and founder of BridgePark Advisors, the financing advisory firm. He's back here in our Bloomberg Interactive Broker studio. He also, last time he was on with us, said that President Biden would step down from the race. So first of all, congratulations, and will you buy me a lottery ticket? Why did you think that so much? Because he had no choice? Remind us of why you were thinking about that, because it was before he did it, obviously.
Yeah, I mean, as you recall, Carol, this was right after the former president was shot. And I thought that, that opportunity for him to look so presidential, frankly, was going to give him a real bump. And I thought it was going to force President Biden's hand. And fundamentally what I told you is when I believed that when he was convinced and his closest advisors and confidants were convinced that he was going to lose, he was going to do the right thing and be a patriot. Do the right thing for the country and for the party, and that's ended up being
that's
what he did.
So your thoughts on last night and what the race is now? Did we get enough when it comes to economics and policy and things that Americans care about?
I was actually surprised about how little the debate actually covered economic topics. Where you look at all of the polling, it says economic issues are the most important things that are going to drive undecided voters' votes in the election. One is the economy, and two is inflation. I'm not sure how
Kind of go
inflation
hand in
is
hand.
not part of the economy. But I think we got far less of a real substantive dialogue on those topics than I would have hoped and expected. And I also thought that there was really very peripheral conversation around China, which I also might have expected, given the important issues that our country faces with its greatest competitor.
We did get some conversation on tariffs, and Donald Trump did push back on what we heard from Kamala Harris in that clip just now by saying that the Biden administration did leave intact some of the tariffs that the Trump administration had put on China. What are your thoughts around those types of protectionist trade policies?
It's interesting, Tim. Actually, both parties are really largely aligned on tariffs and trade, actually. There are, of course, some nuances. Former President Trump is doubling down on his reasonably aggressive, trade stance. What he said, at least, was he would implement tariffs of 10 to 20% across the board and 60% of goods coming in from China with a broad brush. I don't think that's particularly effective. To be sure, tariffs have an important place to protect industry, U.S. industry, where those industries are critical to our national security interests. But when you do it on a broad brushed basis, at least it's my view, that the light's not worth the candle, because clearly it's inflationary. I think it actually costs you more jobs than it saves you, and costs get passed on to the consumer. And frankly, there are a lot of industries where we are just not competing effectively on a global basis, and as a result, taxing those goods coming in is just bad for U.S. consumers and is inflationary.
So it's not apples to apples in terms of what Donald Trump is proposing now, Stefan, in terms of more Chinese goods that are coming in versus what we've seen during the Trump administration, what continued into the Biden administration, specifically on high tech and chips in particular. So it's not the same thing.
Well, the tariffs, let's separate. One of the things the Biden administration did was export controls as it relates to chips and critical technology. But specifically as it relates to tariffs, this started with steel production. And the issue around state-owned enterprises in China, which control steel production and now are by far the leading producer of steel around the world and have flooded the market. The fact is, President Trump put on tariffs for imported steel from China. The fact is the Biden administration kept those tariffs, but the fact is China's behavior has not changed. And so the question always should become in these circumstances, was it effective?
Right.
And at least so far in changing Chinese behavior as it relates to steel, it hasn't been effective. And in fact, it's gotten in many ways worse because the Chinese economy has slowed, and as a result, their domestic consumption of steel has gone down. And what's happened to all that steel that continues to be produced? It's being sent overseas, driving down prices and creating real global instability in that steel in the steel market.
You did mention the economy and inflation, two things that we know, thanks to poll after poll, are on the top of mind for voters. We learned a little bit more about Kamala Harris last night, but still, since she's relatively new as a candidate and doesn't have a full policy position out there, we don't know everything about how she feels about this stuff. Some of her other policies that she's unveiled in recent weeks include no taxing tips. She's come out with that. First-time home buyers getting some sort of home buying credit, expansion of the child tax credit, supporting small businesses, we learned in recent weeks, with tax cuts there.
But let's go through a couple of those, Tim.
Yeah,
So,
I want to talk specifically about the home buying one.
The home buying one to me is interesting, and you didn't mention obviously the whole price gouging,
price gouging
issue
as
that
well.
she raised, because to me these both reflect a fundamental misunderstanding of reasonably simple economics, right? Which is, if you give somebody $25,000 to go buy a first home, and there is frankly not a demand issue but a supply issue, let me tell you what's going to happen. That curve goes up, and houses are going to cost $25,000 more.
Basic economics.
Basic economics.
Yeah.
So I just don't see how that works and does what she wants to do, which is to actually assist new home buyers in affording their first terms. What it's going to do is just increase the prices of homes. And so to me, this is very similar with the whole price gouging issue, which she talked about in groceries and in food retail. As we all know, when you don't let the market set prices, that leads to inefficiencies.
Right.
And in this particular case, would lead to shortages in certain goods. Again, supply and demand, as Carol suggested, sets prices. And when government artificially sets prices, you lose the signaling impact of what supply and demand leads to, and as a result you get market inefficiencies, which is going to be bad ultimately for consumers, because when they go buy macaroni and cheese, it's not going to be on the shelf,
right,
because companies aren't going to be able to make enough money. I would also observe that it's not like the food retailing industry is such a profitable business.
Yeah. Right.
I mean, at the height of the pandemic, the best grocers were making, 5-ish% margins.
Right.
And so as a result of that, the notion that they're price gouging is a little bit of a head scratcher.
One thing that stuck with me or stayed with me from our last conversation is, the stock market isn't Main Street, right? And so there are a lot of Americans that are struggling. So I'm trying to understand, because this race is a close one, right, no matter what. And these are two people who stand for very different things and are very different candidates. Why is it in such a rich country and in a market where companies seem to get richer and richer that we're not able to pass that wealth on to more workers? I know wages are starting to go up, but how do we fix that?
Well, look, I mean, there are.
I know that's a big one.
that is a big one, and it's it relates, at least in my view, to education, to opportunity, which touches a whole host of policies. But I think very narrowly, as it relates to what is causing the dissatisfaction with the economy today, it is because prices are elevated. And prices are elevated because of what happened in COVID and what's happened after, where both administrations, frankly, have a lot to answer for because of the increase in the deficit that both parties' policies caused. And until they tackle that, I think the conversation about the stock market is high, interest rates are low, inflation is under control is fine. But as your last guest or commentator suggested, inflation is interesting, but it's a point-to-point measure. It has nothing to do with prices.
Right.
Prices are high.
Right, and they haven't come down.
I think the problem is Americans, most of whom have not experienced inflation, don't understand that about inflation. They think of inflation as what they pay at the gas pump, and they see those prices fluctuate. So they do see gas prices come down, and maybe that's what they expect other prices to do.
And gas prices are now at a 3-year low. Former President Trump is very fixated on oil and gas prices because he thinks there's a direct linkage between gas and prices and inflation. I don't get that economics either. In fact, there is no more of a global commodity than oil and gas, and those prices are not set narrowly based on U.S. production. And so I think that's another example of, especially given the importance of energy in Pennsylvania, another example of campaign rhetoric as opposed to real economics and real math.
Every time we wrap up with you, I'm like, wait, I have a million more questions. So you have to come back again.
We're always happy to join you guys.
So much appreciated. Stefan Selig, thank you so much. Managing partner over at BridgePark Advisors, as we say, former Undersecretary of Commerce for International Trade at the U.S. Department of Commerce. That was during the Obama administration, but really looks at things from, as we say, the public and private sectors. All right, folks, you are listening and watching Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jenny Rooke is the founder of Genoa Ventures. It's a venture capital firm that invests in, as she says, the, quote, next generation of companies at the convergence of technology and biology. Jenny Rooke has invested in such companies as Intabio. I'm saying it correctly.
You got a lot of these on the list.
BrightSpec.
I will say biotech is not easy when it comes to pronunciation.
Yeah, can we just talk
What's
about
the deal
that?
with that?
Where's the consultant to say, all right, let's just call them Smith & Company or something?
Well, then they would all be called Smith & Company.
All right, but you know what I mean.
Right, yeah.
I mean, I guess they do a lot of work, and there's something connected with it. We said you're from the Bay Area.
Yes.
You're here in our studio, so welcome.
Thanks for having me.
Tell us a little bit about, first of all, you're a sailor, right?
I am a sailor.
Hence the name of your company?
That's true. When I founded Genoa almost 7 years ago, it was really important to me if I was going to start yet another venture firm that we were known for something distinctive. And I wanted that to be about our culture of really supporting founders. And part of why we recognize that is recognizing we're not the captains of the ship. It's not our show. They're the captains. We're not even the boat. Right? At most, we're the sail. So the Genoa, as you know, Carol, because you're a sailor, is a sail. And that's where we take our name from.
It's really, I love it. I love it. So wait, how does that also then think about, there are so many startup companies out there, right? Especially, ones at the very early stage.
Although fewer and fewer in the current environment.
Well, because there hasn't been as much money, right?
That's correct. Yeah.
All right. So how do you pick and choose then? Well, first of all, that's interesting. If it's not as many out there, is that more frustrating for you? Or is it that then the companies that are actually getting the money are pure and kind of more ready to go?
I think that's what we're going to see coming out of this sort of crucible of the last couple of years, is clearing out a lot of the chaff from the hype of 2020 and 2021. Now, we go really early at Genoa, and so we had the, I would say, advantage of picking our bets and being really disciplined about pricing. I think it was a little harder for later stage investors who were just had a deluge of a lot of companies that maybe were not particularly selected well. There wasn't a lot of selection pressure.
Right.
So coming out of that, I think this is a healthy reset. It's obviously very difficult for a lot of people, and I don't want to trivialize that. But as far as kind of the math, how the math works in venture, you need to have a little bit more balance between who gets the money and who gets to keep going.
But is the math in venture different than say like a consumer tech company or like like consumer tech sector or ad tech, for example? It's hard to talk about this in the context of what's going on in tech because there are just a small number of really huge companies that control so many of these spaces. But with biotech, is the bet different?
Yeah, I love this question. We think it is, particularly our biotech. So often when people say biotech, they're thinking about drug companies, right? Which are very important and have demonstrated that you can invest in fundamental innovation in biology and not only change the world, but make a lot of money. So we think that's true much more broadly with biology-based companies that include other ways to participate in healthcare, like diagnostics, precision medicine, but also other bio-based verticals that aren't even about healthcare, like what did you eat this morning? Like that was biology.
Right. Hey, Carol, you weren't here for this, and hopefully you weren't paying attention because you're on vacation, but Apple unveiled this new suite of devices on Monday. And one thing that interested me was the focus on health. Yeah. What did you make of their move into hearing health with this idea of using AirPods as a hearing aid, and then also the sleep apnea stuff with the Apple Watch? What's your view on that?
I think the broad theme is exactly what we're saying, which is companies coming from tech and investors coming from tech are seeing that it's very important to get information about what's going on with a person before they become a patient, right? And that's where we can really intervene in better wellness outcomes. Now, Genoa invests in more really fundamental biology with the understanding that probably can't get everything you need to know about, say, cancer or drug selection from sound. So you are going to have to take a biological sample. You are going to have to analyze that one way. That's where we get into genomics and proteomics and those kinds of terms to get kind of the advanced information that's going to help patients and doctors.
What would you think, I'm thinking about the Bloomberg audience who's listening in terms of biotech, what aren't we talking about a lot? You know what I mean? Like, I feel like when it comes to, we think about technology in the healthcare space or something, it's like, all right, so I don't have to go in and fill out the forms anymore. Right. But what are you seeing that's just kind of really innovation next step when it comes to biotech?
I love this question because we think it comes down to broadening the definition of technology. And you already kind of alluded to it because it included, in your example, the hardware. Mm-hmm. So sometimes when people say tech, they're thinking about software. So data, AI, yes, lots of great stuff going on there.
I'm tired of counting my steps. I've gone back to a normal watch.
You count them yourself? There are devices that can do that.
I kind of know at the end of the day, have I walked or have I sat on my butt a lot?
Hasn't really helped you, right? Exactly.
Sorry.
Yeah. But if you get improvements in those kind of hardware innovations and chemistry and things that we can't even see, like at the microscopic level, it can really change how you think about impacting healthcare in a way that goes well beyond kind of the current tech.
So carry it out for us. So tell me, like in 5 years, you know, I don't know, tell us where this might all go.
Yeah. Well, one of the things I would say, Genoa, we're very early stage investors. We like to be that first round capital partner in venture.
Right.
So we're thinking 7 to 10 years at the earliest, and then kind of the 100-year thesis about how can biology change all of our lives. Again, not just healthcare, but the food that we eat, the things that we make, the chemicals, the manufacturing. How can we do that in a way that's more sustainable and beneficial to the planet?
So where does it go?
So it goes to more efficient uses of inputs to make better crops that people want to eat, that are healthy for them and healthy for the planet. That's also biotech.
Does it get rid of plastics?
Ultimately, or turns them into something that isn't a dirty word.
Such as?
Bioplastics would be kind of the immediate next step. Can we make the materials that we associate with plastics, like your water bottle, out of something that it doesn't come from those same chemicals, but does the same job?
What's a concept to you that's most exciting about the future? What's the world that you imagine that realistically we could be living in?
Yeah. So what I've seen, I got my PhD in genetics in the late 90s, and what I've seen in just a couple of decades is we've gone from knowing that DNA is important to being able to read it and now write it and also change it. So the things that we can do in software, right? We can actually write programs that do things for us with the data. We're going to, maybe not over our lifetimes, it's hard, it's going to take time, have more and more of those same capabilities when it comes to reading and understanding the book of life, and how do we use that in responsible ways to make the products that we need for day to day.
Why has the DNA, go
No
back.
dino DNA yet for Jurassic Park.
There is, actually.
Is there? So, okay. Go on.
Yeah, you
Can we do this?
Yeah, I mean, I love that little video of Mr. DNA, right? He was not wrong. You can get smaller and smaller samples of DNA and find out what was going on in there. And not only that, actually start to use that information more and more to program, say, cells or other things.
Velociraptor is like just around the corner.
But let's not
Hopefully
make
not.
velociraptors.
Yeah. But I do think about DNA and the mapping and how much time and money was spent. And I remember, reporting like, okay, if we just, we get this and there'd be a finding and so on and so forth. But in terms of figuring out how to make us healthier or deal with ailments and catch them and change them and alter that seems to be still a bit elusive or longer term.
I do think it's important to set expectations correctly. I think we can get wrapped up in the potential, but then need to recognize that it does take a long time to figure out how to do it well and safely and responsibly. So that's part of what's going on, is let's not make velociraptors as we go on the path to things that actually help humankind.
Hey, Jenny, I got a question coming from a member of our audience who is curious about how small investors, people who aren't necessarily venture capitalists, can play in this space.
Yeah, I think that's an interesting opportunity as well. It's obviously the private markets and the accessibility of private market investing is a place where you know better than I do. There's been some really interesting innovations. And so you have areas like AngelList or Y Combinator, other kind of platforms where it's possible to access those kinds of innovations. But it can be really challenging, I think, for the individual investor because, to your point, this takes a lot of expertise to do well. So I think finding managers who have that expertise kind of in their particular areas and then matching that to things like some groups or investors who try to make those connections. You have wonderful groups like Raise and The Bridge who are elevating emerging managers in specific sectors that can help connect them to individual investors.
So your companies, as you say, 7 to 10 year runways.
Just like venture. We're
not
trying to reinvent venture here, trying to use best practices.
And in terms of attracting new money to put to work, what's that environment like just before we go?
I think it's always been challenging it's just challenging to attract money to early stage startups, right? It kind of should be, right? It's challenging. And part of why I started Genoa is I saw that it was particularly difficult to do it for these companies that are biotech, but not quote biotech, not drugs, and yet so much explosive opportunity fueling innovation in the spaces. What's exciting to see is more and more, I would say, later stage investors getting excited about the opportunities there and being interested in funding these companies when they get to, for example, revenues or profitability. But there's still an opportunity in the earliest stages for that kind of technology and product development investing that we're doing at Genoa.
Bond Pet Foods.
Bond Pet Foods is an interesting example.
Plant-based pet food.
It's a way to use technologies that already exist to make the things that we eat, like we use yeast to make beer and bread, for example, but to put into it the nutrients that you might want in your pet food.
I feed my dogs carrots, just gonna say. Why not?
I'm coming over for dinner. Not bad.
Okay, come on over. Jenny Rooke, thank you so much. Look forward to next time already. Founder and Managing Director at Genoa Ventures, joining us right here in our Interactive Brokers studio.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, got about 18 minutes left in today's trading session. Carol Massar along with Tim Stenovec live here on Bloomberg Businessweek. Man, we're up on the NASDAQ, as you just heard from Charlie breaking down those numbers, 1.7%. So well off our lows of the session, and we are just at our highs.
Well, let's see what Jimmy Lee thinks about it. He's founder and CEO of the Wealth Consulting Group, joining us from Minnesota, not from Las Vegas.
No.
Not from the Bloomberg Interactive Brokers studio where we found him before.
What are you doing in Minnesota?
Yeah,
Can
what are
we
you doing?
even ask?
You on the road?
I am on the road. I do a quarterly business coaching meeting, and this is where the meeting is this time.
What's on the mind of, when you think about, when you talk to business owners, what is top of mind? I think it's kind of interesting coming off the debate last night. We got a little bit on policy, a little bit on the economy. But what are you hearing?
I think some of it is just interest rates, access to capital, looking forward to possibly rates going down, maybe being able to borrow money to do deals at lower interest rates, which will make those projects look better, perform better. Also looking forward to what's going to happen in the election here, because we could have some fairly substantial changes in the tax policy depending on who gets in and how the Congress sets up. So I think business owners are a little bit anxious to see what happens there. But overall, I'd say that, most people I talk to are still fairly optimistic about what's going on. And with lower rates and the Fed cutting rates here soon, I think that's they have something to look forward to in terms of optimism.
So in terms of investing at this point, would you suggest investors commit money to the equity market? And if so, where would you do so? What about on the fixed income side of things, as we are just about a week away from the next Fed meeting and that Fed decision where we are expected to get a 1/4 point cut? What's your advice?
Well, Carol, I still believe that we've got some upside in equities, even though we came into this week with S&P 500 up over 22%. That is a very good year so far for the index anyways. And so a correction of 5 to 10% is something that would be very typical or normal for me after a run up of that magnitude so quickly. And so I think if we get some volatility, I would put cash to work on those dips into equities. But if you want to have a safer play, I think bonds represent a nice opportunity for investors right now, with yields definitely coming down. Bond investors will get a nice coupon from the interest that the bonds pay, but also maybe a little bit of a pickup on the net asset value of those bonds as rates come down. And so I think you'd be, in a diversified portfolio, as many people own both stocks and bonds, and do well going into the end of the year and beyond. And as we start to focus on next year, of course, we have the election ahead of us to really, help I think investors decide how aggressive they want to be.
Jimmy, which bonds are you talking about? I mean, where on the curve are you talking about, or are you talking about, munis? What do you think?
Corporates, yeah.
Well, I like a little bit of duration. So as you guys know, we've added duration to our bond portfolio. So somewhere between like the 7 to 10 year type maturities, even just the ag, I think represents a good opportunity for a lot of investors today as yields come down. So I would expect that the 10-year treasury yields come down. as I've been saying, closer to 3.5%. I think it's 3.65-ish today, kind of we're hovering around. And so we're getting close to that already before we even have a rate cut. And I think today's CPI number kind of makes it a fairly high certainty now, high probability that we're going to get a 25 basis point cut this month, which I think is fine to get started. But I think the Fed really needs to keep an eye on inflation and on the economy and make sure that if we see signs of a weakening economy more than expected after this huge adjustment in the jobs numbers this year, I think the Fed could be more aggressive down the road here.
Jimmy, you shared some notes with our producer, Paul Brennan, and you say my biggest piece of advice is for investors who are indexing into the S&P 500 or loaded up in their mutual funds in the big tech names is to remember 2022. And you talk about whether it was Meta or Netflix and some of the other big FANG stocks and how much they were down. Why is it important to remember that?
Well, the top 10 companies in S&P 500 now represent well over 30% of that index. And so a lot of investors buy index products. And so the S&P 500, if you think you're diversified across 500 of the largest companies evenly, that's just not the way it is, right? Because of the market cap weighted index that it is. And so investors could suffer some pretty large declines if you have, your money tied up in a lot of the index products, maybe more than you think, concentrated in those few names. And we also have a lot of investors that are loaded up in the names that have gone up the most. We're having a nice rally in tech today, but right now, Carol, we're underweight tech, and we're overweight some of the cyclical sectors. We're overweight some of the sectors we think will do well when rates go down, like real estate, dividend paying sectors. We've seen a nice reversal in some of these areas over the last 30 days, seeing a trend starting to form in areas like staples, healthcare, some defensive type sectors that pay dividends, but bracing for rates coming down.
Jimmy, I know you're underweight tech. You just told us that, but where do you not want to be? What do you want to avoid?
Well, I just don't, Tim. I think you don't want too much money in those high growth names that have gone up so much so quickly.
I can name a few. Are you saying?
I really don't want to. I really want to throw those out there, but we all know which ones they are.
Okay.
If you've gone over 50% returns year to date, you know who you are, and so I just be careful not to get too greedy. And we could see some fairly steep declines. I mean, I thought the NVIDIA earnings report, for example, was fantastic, but the stock went down. It's up today a lot, but it went down a lot after that. So that means to me there's a lot of investors in names like that are momentum investors, maybe even shorter term traders. And so when companies stock prices price for perfection, I think you have to be careful. Although I think that that specific company, you could be a buyer on the dips. So I think there's some more opportunity there. But just make sure that your portfolio doesn't have too much of it as a percentage, and just try to not be too greedy.
Hey, before we go, I think we'd be remiss if not asking you about the debate last night. Just got about 40 seconds left here. Anything of note for you in terms of what we are getting from the candidates, be it last night, that make you think, I don't know, something when it comes to the investment environment going forward, or that is making you adjust some of your strategy as a result?
Well, I'm not really sure about adjusting our strategies, and I would really caution investors to not get too, focused on the rhetoric, because what they're campaigning on might not be exactly what ends up happening. And so, really, what happens in Congress is what I think matters as well. And so, I think investors like a split government so that you've got some checks and balances there. I thought last night's debate was very interesting. I thought that the moderators seemed like they were kind of ganging up on the one candidate. And so I don't know. Yeah. I hope to see another debate. I'd love to see another one, and continue to focus on the issues and see where policy really changes for people that are concerned about the economy and the market.
Well, and Donald Trump has said he would participate in a second debate on either NBC or Fox, so we'll see what happens. Jimmy Lee, thank you so much, founder and chief executive officer of Wealth Consulting Group from Minnesota.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.